Welcome back to our video. Welcome back to our video lectures on Chapter 3. So we are on Chapter 3 and we are continuing with this illustration on Learning Objective 3. So now we have Phoenix equipment, and here are several situations that we should journalize. And note the date is December 31st for each situation. So we have interest expense of $1,200 that must be paid. So here we've incurred an expense, so we have to show the interest expense, and then we credit interest payable. Our next situation is we are showing the unadjusted balance in supplies account is $3,200, and the total cost of supplies on hand is $1,500. So here's our supplies account in T account format. And we have $3,200 as our asset balance, and we are showing $1,500 that has to be at the end. So now we know that we're going to have $1,700 as our supplies expense for the month in which we incurred, and then we're going to reduce our supplies account. And note our calculation here in equation format, and note I usually do it in a T account format because that's just a better visual for me. Moving on to our next journal entry, we have salary expense of $7,000 per day, Monday through Friday, and the business pays the employees each Friday. But December 31st happens to be on a Wednesday. So we do have to accrue 3 days, right? Monday, Tuesday, and Wednesday. So if they incurred $7,000 on Monday, on Tuesday we have another $7,000, and on Wednesday we have another $7,000. Therefore, we're recording a debit to salary as expense for $21,000, and we're showing a payable, a liability. We owe that on December. They're going to pay them on the 1st or the 2nd on Friday. Now, on July 1st, when the business collected $15,000 rent in advance, what we did is we debited cash for this transaction of $15,000. And then we obviously, that's what we got, and we credited our unearned revenue, which is a liability account for the $15,000. We owe that service. So, and unearned rent revenue, so the tenant was paying for the entire year's rent. So since it is $15,000 and this was on July, so this is a half a year, all we have to do is divide it by half a year or 6/12 if you want to do it that way to get $7,500. So we're going to debit our unearned revenue account and then credit our rent revenue. And remember, revenue has a positive balance on the credit, and then unearned revenue is a liability, so it has the opposite. Now, interest revenue has been earned, but it hasn't been received yet. So in this case, we're going to show a receivable that somebody owes us $900, and we've actually earned that revenue. Moving on to now our next transaction is we purchased at the beginning of the year equipment for $50,000 with 5 years of useful life, no residual value here. So we want to record the depreciation. So in this case, we're going to take our $50,000 and divide it by 5. This is known as straight line depreciation, done with SLN. SLN is the formula in which we do that in Excel. So if you hit equals SLN, it'll give you straight line depreciation. Remember, we record depreciation expense and then the accumulated depreciation, our contra asset account. Now we are actually showing the book value. So in here we're taking our full $50,000 of equipment, and now we're subtracting the $10,000 that we added to get our net book value. And this is what's shown on the face of the balance sheet. And that will conclude this video here.